Hi, everyone. Welcome to our webinar on MSR Portfolio Management and Accounting. Before we dive into today's topic, I'm going to run you through some housekeeping items so you can best leverage our platform. Our webinar dashboard is interactive and customizable. You can personalize your view by moving, resizing, or hiding different elements on the screen. Simply use the corners of each icon to adjust the size or position. All equipment and resources are also available to you in the ribbon running across the top of the dashboard. From this ribbon, you can download slides, ask a question, take our survey, and more. We will do our best to address your questions in real time, but if we don't make it through all of them, we will follow up with you individually. To let us know your thoughts throughout the presentation, use the emojis on the bottom of your screen. Please also fill out the survey anytime during the presentation. Your feedback is valuable to us, and it is used to craft future webinars. For those of you seeking CPE credit, you will need to answer all 4 poll questions during the webinar. CPE certificates will be sent out via email within a couple of weeks. Lastly, the session is being recorded. You will receive a link to the recording within a couple of days. If you want a copy of the slide deck, go ahead and download it from your dashboard at any time today. Now that we've covered all of the details, I'm going to turn it over to Jennifer Hanna, and she'll introduce today's topic and all of our other presenters.
Hello, I am Jennifer Hanna. I'm the partner and service line leader of the mortgage banking audit practice at Richey May. I know a lot of you, I looked at the client list and I know most people on the call, so we're excited to present this MSR presentation to you all. John Murphy, many of you work with him. He is a manager on our team. He's been with us for quite some time and we have some friends from MCT joining us. Bill is the Senior Director, Head of MSR Servicing at MCT. He has over 17 years of experience with Fannie and Freddie Mae as the Fannie and Freddie as the Vice President overseeing the Western region. But overall, he has 30 years of experience, and he's in really good company with Azad, who also has 30 years of experience in valuation, servicing, best practices. We have a really good group of experts on the call, so I'm excited to hear what they have to say. We are going to start with a brief overview of accounting methods and then strategies for active portfolio management, and then sprinkled throughout that as MCT talks, we're going to try, John and I, to kind of tie that back into how that impacts your audit and potential journal entries. So those of you who want CPE credit, we're going to start out with a poll question. This will be our first of 4. What's your approach to servicing? To sell servicing released, retain servicing both, or if you have something completely out of the box. So if you want CPE, go ahead and complete this first poll question and we will proceed with the presentation. And let me give you a minute or two to submit your answers. Okay, I'll probably give a little bit more time, but we'll jump to the next slide in about 10 seconds, so get your answers in. Okay, I'm gonna close this question and So it looks like sell servicing release 10%, retain servicing 15%, and then both. It's kind of what I was expecting. So thank you for completing that survey. So we're going to start with just a quick overview of accounting for MSRs. John's going to take this, and then we'll get into managing the servicing portfolio. Go ahead, John.
Great. Thank you, Jennifer. Yeah, so we're just going to touch on a brief overview for accounting for MSRs. It falls under ASC Accounting Standards Codification 86050, which pertains to service and transfers. MSRs are always going to be measured at fair value initially, at the date the servicing right was acquired. That fair value is often determined using a discount cash flow models that consider, servicing fee income, cost to service, prepayment speeds, default rates, and discount rates. It is best practice to use a pricing grid for that initial recognition of the MSR. Subsequently, there are two different paths you can take to account for the MSRs. The first is going to be the fair value. And this is where the MSRs are remeasured at fair value at each reporting date or the balance sheet date. And those changes in fair value are going to be reported in earnings. Typically on our statements, you would see that in valuation adjustment and deletions of MSRs on the statement of operations. So we'll kind of dive into some pros and cons for the fair value method. The pros are it is the current economic value. It just matches the true economic value because we are truing it up to what the market says it's worth. It's very simple to adjust because at the reporting date, you're just going to take that third-party valuation and make your adjustment. The cons to this is the financial statement volatility because obviously there's exposure to large write-ups and write-downs of the MSR assets. The second method is the amortization method, also referred to as low-com. This is where the MSRs are going to be recorded on the balance sheet date at cost, and then they're amortized over the expected future cash flows from those servicing fees. Impairment testing is required on this method, so we'll dive into that here a little bit further. Pros and cons. So the pros are the amortization. It's going to be less income volatility because there's no significant drops or increases in that fair value due to the market conditions. It is a more conservative balance sheet valuation, and it does technically follow the GAAP matching principle. However, there are some cons to the amortization method of subsequent measurement on the MSRs, and the main one is the administrative burden, and that's because you have to amortize on a monthly basis. You're expensing it out, but you also have to test for impairments on a quarterly basis. And impairment's going to occur when the carrying value is greater than the fair value. At that point, you would have to book a contra asset, which is going to be recorded through the income statement. It's also the administrative burden also ties in because you're not supposed to amortize these on a straight line basis typically, because we'll dive into this a little further, but that effectively means, because we apply an income proportional or cash flow based method, and that's usually because, prepayment speeds are going to increase over time. So a lot of those fees and stuff you're going to get more upfront before that kind of phases out over the life of the MSR. And then you cannot recoup all impairments. You can only recoup up to the original carrying value. And this election, this subsequent measurement election is made based off the servicing class of servicing assets. So you can technically, apply different methods based on the various classes of those MSRs. But once you elect fair value, you cannot go back on that election. However, you can change from amortization to fair value, which would occur at the beginning of the fiscal year with an opening equity adjustment. Of the two, the fair value accurately is representative of the current economic position. And based off what I see, I would say our client base is probably 75% fair value and leans to just about 25% amortization method.
Just to jump in, electing fair value on different classes, they have to have a different risk profile. So just be careful with that. Before you take that approach, reach out to us and we can kind of walk through that with you. But typically you're going to have all fair value or all amortized cost, regardless of the tranches, unless there is like a specific risk file that varies and it's not just difference in interest rates or prepayment speeds. But thank you, John. Appreciate you going over that. And then this is just a brief, as we go through, we're going to turn it over to Bill and Azad as they go through their presentation. John and I will kind of jump in on what we see as part of our audit process of common entries, things that clients, CFOs, controllers should maybe pay attention in alignment with secondary to make sure that they're understanding kind of what can get you with an MSR portfolio from like a cash flow perspective or journal entries during the audit. All right, so period over period comparison. If we want to, Azad, I think this one was yours.
Yes, thank you, Jennifer. This particular report is utilized by MCT on a regular basis with every valuation we perform. It helps us understand the underlying dynamics within each portfolio. It helps us identify the changes in the value, which part is impacting the value. Is the valuation impact coming from the payoff, principal pay down, new originations, the market rates, and so forth? And depending on the portfolio characteristics, we see more and more the current payoff levels are helping with the value because like in this particular case, the overall portfolio WAC is 6.1 while the payoff is 6.9, has a WAC of 6.9, and that's going to relieve some of the valuation and help improve the overall value. But then on the other hand, you see the originations coming in about 6.7 WAC. That has a negative impact in the current market environment. So utilizing this portfolio will help us understand what's going on within the portfolio itself and helps us understand and isolate the individual drivers for the overall value.
Thank you, Azad. Oh, we have a couple of questions I'm going to jump in on. Paul, ESS and VIE accounting, that is such a hot topic. I would be happy to reach out to you directly to kind of talk through that. It's not part of the presentation, but we're getting a lot of questions on it and we're seeing clients get into it. We also have what percentage of servicers use fair value versus LOCOM. Azad and Bill, for us, we probably see 75% of our clients on fair value, the remaining on LOCOM. That might be good to have your perspective on that as well.
Sure. Generally speaking, among our clients, we see about 60 to 70% use fair value accounting. However, if you dig deeper, we see IMBs and banks choose fair value accounting more than LOCOM accounting. Credit unions, among the credit unions that we work with, it's the opposite. We see more credit unions utilize LOCOM versus fair value. And the reason for that is the conservative approach to accounting and managing their books.
Perfect. And then the last, yes, you can absolutely go from LOCOM to fair value. It's the beginning of the audit year adjustment. Problem is, once you elect fair value, you can't go backwards to LOCOM. So LOCOM, just really think about that because there's definitely some income statement volatility with the fair value methodology. And then John, I'm going to turn it over to you.
Perfect. Yes. All right. So as far as common audit issues or what we typically see from an accounting and audit perspective, first we'll talk about disclosure. The financial statements require clear disclosure of the MSR activity, as you can kind of see in the table at the bottom of the slide. So one of the main entries we typically make or run across is when clients aren't tracking MSR additions separately from the fair value adjustments. So normally we will just make a reclass of that amount, a reclass entry to back that out so we can disclose it separately. And then also, once part of the portfolio is sold, there can be errors in those realized gains or losses if the MSR additions and changes in fair value are not properly recorded in the trial balance. So as far as those MSR additions, it's just super key to keep those separate. And the same with the sales, we have to disclose that as well. You'll see that at the bottom there, the deletions due to sale of MSRs. So. Right.
Okay. And then one nuance we're going to have this year on our financial statements, breaking out that change in fair value between valuation model inputs and then collection and realization. And we've talked to 7 different servicing valuation providers to kind of make sure everybody can pull that data. So we'll have some more information out for our clients on that shortly. Okay, sorry, another poll question for those of us needing CPE credits. Do material changes in the company's MSR valuations have significant impacts to net worth and covenant calculations? Meaning, when your valuation changes on your MSR, do you ever get in a bind on any net worth or covenant calculations, or is there a pretty good cushion on that? If everyone wants to take a minute to answer this poll question. Okay, I'm gonna go to the next slide. So if you want to get your poll question in real quick, go for it. I'll give you another 5 seconds. And we'll move on. Okay. Yes, yeah, that's what I was expecting. We saw, especially with the Ginnie Mae capital changes, we have seen some challenges with that. So this doesn't surprise me. All right, we are going to turn this over to MCT, I think, Bill, to kind of go over overall risk management and Azad, third-party MSR portfolio valuations.
Excellent. Thank you, Jennifer. And I did want to take a moment here to thank you, Jennifer and John, for hosting this webinar. On behalf of all of MCT, we appreciate our partnership with Richey May and really have enjoyed putting this together and collaborating with you all on this. So thank you. I didn't get an opportunity to do that earlier, but wanted to make certain that I took a moment to do that. So let's get into the overall risk management. There are a number of reasons that we believe that now is an excellent time for servicers to assess where they are from an overall risk management perspective. Since the MSR asset, to the previous question, is the largest asset on the balance sheet for many mortgage originators, it's essential to make certain that the underlying credit risk and the credit quality is monitored and maintained. But since the dynamics in the market are so incredibly competitive right now, granularity around pricing has really become a necessity. You know, when we typically think about risk management, it's often associated just with credit risk, but that's really just part of the responsibility. There's also pricing risk, there's market risk, there's operational risks that need to be managed effectively. And it's not just about managing the existing loans that you have on your books, it's also making certain that the ongoing day-to-day pricing is appropriate. You know, additionally, is your overall servicing operation equipped to address future operational demands? That's something that we're hearing a lot more of with delinquency starting to tick up, a lot more focused on loss mitigation. So now is really a good time to assess where you are as an operation and make certain that you are taking steps to address future risks that you might have on the balance sheet. So that's how we're thinking about overall risk management, and that's how we're currently advising our clients. And I know, Azad, you wanted to elaborate a little bit on the third-party evaluation. So I'll turn it over to you, Azad.
Thank you, Bill. Third-party valuation is becoming really an important and integral part of managing the entire MSR portfolio if you have one. In the past, like a pre-pandemic, the third-party valuation was necessary to understand the market dynamics and market changes, what's reasonable valuation versus non-reasonable valuation. But after the pandemic, before the pandemic, we started to see market value and fair value. They're aligned very close to each other. They used to be within 5-10 basis points, depending on the characteristics of the portfolio. But since the pandemic, we started seeing a major shift in what is considered market value versus fair value. And the reason for that was the supply-demand of loan production and more entrance into this space that's pushing the value, market value is much, much higher. And that's why it becomes very critical to understand what is driving those market value, what is happening in the market. And third-party providers become essential since they have more insight of the overall market and not specifically to one portfolio. And they could help provide guidance to what is reasonable value versus unreasonable value. And also the valuation and the opinion that third party provides most likely will help mitigate a lot of the risks that Bill alluded to.
Okay, thank you. Bill, active MSR portfolio management.
Yeah, so I think we're going to keep rolling here on the active portfolio management. Thank you, Jennifer. You know, we all know that the overall economy has remained resilient for the past several years. I don't need to tell everybody on the phone, but, you know, very low unemployment levels, historically low delinquency rates, foreclosure rates, bankruptcy rates, predictable prepayment speeds, historically low prepayment speeds overall, and then very stable MSR values. You know, these trends can certainly result in complacency relative to risk management because things have gone so well. But there are clearly some underlying risks that exist, such as rising consumer debt at record levels. Insurance premiums continue to rise. We're continuing to hear about serious delinquencies on student loans. All of those things require ongoing monitoring and oversight. And listed here on the chart are a few steps that we recommend servicers take to become more active relative to their MSR portfolio management. So I'll go through them quickly. So transparency and visibility into core underlying assumptions. And this is related to what Azad just referenced around the third-party valuations. Even though fair value is largely based on industry averages, it's still important to have insight into the assumptions. The discount rate, par rates that are being used, float income rates, cost of advances, all of those underlying assumptions are critical to have visibility into. For us, to ensure that our assumptions are appropriate and accurate and current, MCT participates in the Richey May quarterly survey. We use that as our guide. As far as stress testing and economic scenarios, evaluating your portfolio's prepayment exposure is obviously essential. But stress testing and going through various economic scenarios can identify not only potential risks on your books, but also potential opportunities. What part of your book is exposed to refi if rates go down? It's important to have visibility into that and also have a plan in preparation for that potential market event. And then cash flow analysis, based on the types of loans in your portfolio, the remittance cycle could certainly have a material impact on cash flows. For example, do you have exposure relative to advances, and how significant is that exposure? And then prepayment speed trending. Are there pockets where speeds are faster than anticipated? What's driving that? Is it specific markets, specific branches that that you have in your operation? Is it specific loan officers? Is it product types? Understanding the drivers behind the speeds is really important. And then delinquency trending. Without question, we're starting to witness signs that delinquency percentages are ticking up. Are those trends for you in your portfolio emerging across the entire portfolio? Or again, is it specific pockets, specific states, specific product types, et cetera? And then loss mitigation. Historically, servicers have relied predominantly on the credit profile at time of origination and the credit score at time of origination. But we all know that circumstances can change materially for borrowers over the years. We now have the ability to get more targeted with our loss mitigation efforts, which can be actually supported by obtaining updated credit scores. There are the new trended data scores available, can actually help you isolate where your loss mit resources should go. And I guess the final reminder here is, remember, real estate is local. We're reading a lot about supply being at pre-pandemic levels across the country. But if you actually look at the individual states, every state is different. The Northeast is much lower than pre-pandemic. And then states like Texas and Florida are much higher than pre-pandemic levels. So again, real estate is local, which requires really a macro and a micro view of the portfolio to understand where the risks are.
Thank you. That's great. John, do you want to go through how Bill's slide can impact the audit potentially?
Yep. So to build off of what Bill was mentioning in the previous slide in the active portfolio management, and kind of dialing down more into a micro level, if the inputs of the portfolio don't accurately represent the current portfolio, it's going to result likely in an audit adjustments. And not only that, it's going to also bring up, several other significant issues potentially. The misstated valuation, are these inputs incorrect? Are they outdated? That is something we do at RMC. We're going to compare the valuations, your valuation, to similar portfolios across the industry. So that's part of what we do, is scan through those inputs to make sure there is no significant misstatement in the MSR valuation. Building off of what Bill and Azad have talked about also, it can also lead to poor risk management. And the way I think about this here, one application of poor risk management that we're starting to see more of is hedging of MSRs. And I'm just going to caveat, if you are hedging your MSRs or planning to do so, reach out to the Richey May team as soon as possible to discuss, just because it is a bit more complicated than it may seem. But as far as, you know, if inputs are incorrect, your hedging strategies may be off, right? Because it's going to have faulty assumptions, which could lead to further exposure as instead of mitigating it. You know, it could also lead to incorrect financial decisions, such as buying and selling MSRs or the MSR retention. You know, is it time to sell, or should we continue to retain MSRs? And Azad will touch on that later. And then obviously just audit and compliant risk. So it is critically important to make sure those inputs into the MSR valuation are correct and accurately represent your portfolio.
Yeah, and that's one thing, just on the accounting side, also, you know, looking at that servicing tape, what data inputs are in there, doing a little bit of check and balance on what your servicing manager is putting in there, what you're getting from your third party subservicer. It doesn't hurt to go in and make sure we're pulling the right servicing fee, and the G fee isn't included in that servicing fee amount. Just, it's always good to have multiple sets of eyes. But thank you, John. Time for another poll question for those of us needing CPE. What is the primary factor for MSR sales? Good market, freeing up liquidity, advances maybe getting too high on some of your portfolio loans. I'll give everybody a minute to answer this question. We've seen a ton of sales, so I'm curious what Azad and Bill are thinking on this. And from our side, it's a good market, but a lot of the times it's kind of wanting to free up liquidity, and we hear that a lot from clients too, on choosing to sell servicing released as opposed to retaining servicing.
Yeah, Jennifer, it'll be interesting to see what the survey reveals. We see a lot, just given how attractive the bulk market is right now. A lot of opportunistic selling, where it's not necessarily a necessity around advances or liquidity, but it's the prices are just too attractive to pass up. But anyway, that's what we see a lot of. There is a little bit of on the liquidity side, but less than I would have expected. I thought that there would be a lot more of that required in this market, just given how tight margins are. But there hasn't been as much as I expected. So anyway, it'll be interesting to see what the survey reveals.
Yeah. All right, it looks like it's slowing down a little bit. I'm going to flip it in about 5 seconds. So get your poll question in if you need CPE. And my apologies for those that don't need CPE. We have to do it in order to give people their credits. All right. Good market, freeing up liquidity. Yeah, we see it from a different perspective too at Richey May, because we're looking at the financials. So we do see it as like a liquidity conversation, unfortunately. But it's going to change. It's going to get better, and it'll move back to a good market as opposed to a liquidity decision. All right, Bill, retain versus release trending.
Yeah, thanks, Jennifer. This chart really supports the survey results that we saw earlier, and it illustrates a couple of things. You know, the low production environment and narrow margins are driving most servicers to release all or most of their servicing. So we're currently in a 70-30 market, where about 70% of the production coming through the MCT system is being sold on a release basis, with 30% being retained, and that actually includes co-issue as well. But it also reveals that there is week-to-week volatility. You can see that the graph is jumping up and down from week to week, and this highlights the fact that the servicers should remain nimble relative to their retaining versus releasing activity and strategy, because the floor market pricing is not static. It can change day to day, it can change week to week. So from a best X perspective, it's important to remain diligent, continue to monitor where the pricing is, and pivot based on current market conditions and opportunities that might be presented. We continue to advocate that servicers, if they are not, actually originators, if they're not approved to retain servicing, whether you intend to retain or not, it's important to have that flexibility. So we advocate for our clients to obtain that servicing approval with Fannie, Freddie, and Ginnie, just in case. We saw, right after the pandemic hit that flow MSR pricing went to zero and less than zero in some cases. So having the ability to retain if the market forces you to, having that flexibility can be really valuable.
Thank you. And then John, do you want to go through recording MSR additions and kind of what common pitfalls we see with auditing?
Sure. I'll let you build on this, Jennifer. But yeah, for accounting purposes, it's important to focus on the retained versus released value, right? So the SRP is going to be the released value. But when you are retaining those MSR additions, right, we need to mark those at fair value. And the pricing grid is going to be the best practice to do so. Entries may be needed entries may be needed if the company is booking those MSR additions incorrectly, right? So if you're using SRP versus a fair value, there could be an adjustment there. Jennifer, I'll let you touch on those last 2 points.
Yeah, just the MSR values. What we typically see with that is when you just started retaining servicing, you picked a number and you stuck with it, and then you have a bunch of different types of product and it just doesn't get updated. But if you're on fair value at year end, it gets trued up anyway, but it messes up the roll. And so another thing that we'll see when you're not booking those MSR additions appropriately, or let's say, you're on LOCOM, you book the MSR addition at a lower amount, and then you're amortizing it down really, really quickly. You sell your MSR portfolio, and because your MSRs are so understated, you have like a massive realized gain on between what you've sold it for and what you have it reported at, which depending on the client, like not everybody wants their MSR value to be super high, because if you go to sell it, you could potentially have a bigger realized loss, and warehouse lines and others, investors, could they pay attention more to that realized loss number than the unrealized loss number. So we do see it where there'll be a massive gap between LOCOM and MSR fair value, which results in like an uninflated realized gain on an MSR sale. So you really want to dial that in. There shouldn't be that big of a gap between those numbers. And we primarily see it with like LOCOM. And then when you sell with MSRs, at that point in time, that MSR value should be compared to what you've sold that MSR asset for. So sometimes people want to, look at that number in a different perspective to get that realized loss number a little bit smaller, or the realized gain number a little bit higher. So just being thoughtful that you have like a consistent methodology with that, because that does result in the audit adjustments here and there when those numbers aren't booked properly. With that, SRP and fair value trends and Azad, I wanted to have you speak a little bit on your MSR pricing grid that you all offer as well.
Yeah, thank you, Jennifer. We monitor the market on a regular basis. We see aggregator pricing, from different providers, and we've been seeing a consistent SRP level, service release premiums, that tend to be about 15 to 20 basis points higher than what we call a moderate fair value. And the reason the aggregators can afford to price loans at such a higher premium is the fact that they benefit from economies of scale. In fact, they have a recapture operation that's very efficient, and they recapture somewhere between 60 to 80% of all paid in full loans. But when it comes to fair value, when it comes to measuring fair value, we cannot include the recapture aspect of the value because not everyone in the industry have an efficient recapture mechanism to benefit from that. So we see the large aggregators, the mega servicers have that. Unfortunately, small companies, IMBs, even banks and credit unions do not benefit from that recapture. So that's something we cannot incorporate in the fair value analysis. We see a lot of interest in the SRP levels paid by the aggregators, and companies would like to capitalize the loans at those levels. However, that comes with risks, and the risk, can be, very, very powerful when if you're, let's say, you're on low comp and you capitalize at 5.5 to 6 multiple versus fair value at 4.5 multiple. Those SRP levels become very, very sensitive to the slightest rate changes. So to give you an idea, put things in context, if you think of a circle and the fair value is at the center of that circle and the SRP value is at the circumference of the circle, the slightest rate change, that SRP value will move dramatically compared what the fair value movement would be. So that's why we advise clients not to chase those SRP levels. Even if you decide to do so, capitalize at the SRP level, you have to take some countermeasures, i.e. if you're using low comp and you're amortizing, I'm just hypothetically speaking, a 7% rate, annualized rate, if you choose the SRP level, you may end up amortizing at 14 or 15% on an annualized basis. So you have, whatever decision you make, you have to implement some countermeasure to offset and mitigate some of that risk that come with it. Again, SRPs are very sensitive to rate changes and very volatile. Could be, when you look at the P&L and balance sheet, it could create a lot of volatility to those, and that's something you do not want.
Okay. John, do you want to jump into fair value versus SRP and how it impacts the audit to piggyback on Azad's slide?
Yep. Yeah, so MSR sales, just kind of, this slide jumps around a little bit, but MSR sales, just to caveat there, we do see, we do typically run into some hiccups if there is an MSR sale and how the gain or loss is booked. So just remember, any gain or loss from the sale of the MSRs that you're going to record, and I'm talking about bulk sale when I'm referring to this, is just going to be the difference between the consideration received and the valuation that you obtain at the sale date. So that's what's going to flow through to your P&L. Which, as far as fair value and SRP, as Azad's graph kind of alluded to, there's two different levels to it. So the SRP and fair value aren't always going to align and are going to be ever shifting. So if fair value is significantly higher than amortized cost, it may indicate that the MSR value is being understated due to too much amortization expense. If prepayments or runoff are slower than expected, the asset is being written down potentially too quickly. And obviously, if any of these gaps are material, the auditors are going to make an adjustment, and not just the auditors, even investors may push for a reevaluation of the amortization assumptions. Is there anything else you have there to add, Jennifer?
It's just tricky. You have your IRLC MSR component, your pricing grid component, your valuation component. It's a lot of volatility, and it's hard to manage some of that. All right, Azad, do you want to go into fixed rate aggregate prepayment?
Sure, thank you. This chart represents prepayment, overall prepayment for all mortgages, all agencies. And you can see it's very, very low, but it's kind of trending a little bit upwards. But I wanted to point out a couple of periods in time that shows the sensitivities of current market. If you look back at right before November, September we experienced mortgage rates below 6.5. At the same time, towards the end of January of 2025, February 2025, we saw rates dip around 6.5. But the slightest dips in rate, you could see there were spikes in refinancing. That tells me that once rates hit 6.5 sometime in the near future, we should see an influx of refinancing. So that's something we should pay attention to.
Thank you. Bill, serious delinquency rates?
Okay, yeah, thanks, Jennifer. I'll kick this off. Overall, we could see in the chart that delinquency rates remain very much under control. But we know that there are broader macroeconomic pressures that exist that we need to keep an eye on. We keep talking about rising consumer debt at historic levels, insurance costs increasing, DTI trending, student loans that seriously delinquent rates are increasing. So those are some things that we need to continue to monitor and not get fooled by these low percentages, because there is risk in the system. Additionally, we continue to observe that VA loans are actually prepaying faster than FHA loans. And as a result, their delinquency rates are remaining sort of at a manageable level because they're actually not accumulating. They're finding alternatives to refi. Additionally, if you're holding government loans on your books, you know that advances can put pressure on revenue and capital. You can see the spike on the chart. That spike shows that following the pandemic, there was definitely pressure on advance responsibilities, and something that the industry needs to continue to keep an eye on. Azad, I know you wanted to elaborate. You had a couple of thoughts on the delinquencies as well. Azad?
Yes, thank you, Bill. Just a simple comment. Servicers are becoming very efficient in managing delinquencies and default. But one trend that we consistently see in the market, that any loans get to this point in serious delinquency, basically past 90 days, even when they cure, the probability of those loans going back in delinquency will occur again. There's about 40 to 60% chance of severe delinquent loans that cured will end up back in delinquent within the following 12 months after being cured.
Okay. I'm going to go through this one really quickly. Just be thoughtful of cash flow for delinquency rates. Also, there's often a direct correlation with servicing advances. When you see those delinquency rates tick up, even if your company is amazing at getting those advances back, it still eats up a lot of initial cash flow. And just also thinking about potential impacts on repurchase demands, which impact your loan loss reserve. I would just focus a little bit on that too as you see those changes in delinquency rates. Debt to income ratio.
Yeah, so this is kind of another word of caution. Affordability challenges continue to put upward pressure on DTI, debt to income ratios. But we know over the years, detailed analysis, kind of doing a deep dive into the trending on the impact of DTIs on ultimate delinquency rates. We know there's a direct correlation. And we also know that historically, conforming underwriters adhered to the 33-38 front-end, back-end guideline. But the industry, as a result of these continued affordability challenges and a desire to support home ownership objectives, has really pushed the industry to stretch those parameters. When I think about DTI, I think about the fact that it's actually a gross calculation. It's not net. So you're not even factoring in the impact of taxes yet. So the impact of taxes can obviously be material. So the higher the DTI, naturally less disposable income. So it puts borrowers in a position where they're less equipped to handle expense surprises. So naturally, we should expect that if you have a higher DTI business on your books and in your MSR portfolio, that's an area that would require some focus and preparation relative to loss mitigation, because those borrowers are, if they continue to increase relative to their consumer debt, will be under pressure relative to making their mortgage payments, and could obviously end up in delinquent status. Getting ahead of that, is certainly important. So again, we're starting to see signs of loss mitigation activity increasing, and now's the time to make certain that you're prepared for that. So again, word of caution, something for all of us to keep an eye on. Thanks, Jennifer.
Thank you. Okay. Loan retention impact on P&L, Azad.
Yeah. So one of the primary focus of any business, any mortgage lender and servicer, we always emphasize that managing a servicing portfolio should not be centralized or concentrated in one particular department. Capital markets should be involved, the lending division should be involved, mortgage servicing should be involved, and particularly finance. In this particular example, I wanted to highlight this combined effort that all should focus on. The retained release chart that we saw earlier, we're seeing about 30% retention level. But in this particular example, this data right here was about 21% retention rate for this particular portfolio. That amounted, if you look to the right side, amounted to about 4.5% of the entire UPB for the portfolio. But then if you look at the two lines above that, the payoff and principal pay down, the payoff rate is almost 4% UPB. However, a lot of companies overlook the fact that scheduled principal payments and curtailments are increasing rapidly. Right now, for this particular portfolio, it amounted to almost 5.5% of the total portfolio. If you combine payoff and principal pay down, that's like about 9.3%. But the new addition, the retained portion of the originations, amounted to about half of that. In dollar terms, the fee income, even with retention, at 21% retention level, the company lost $500,000 in potential service fee income. If you remove the entire retention, make it zero, that's almost $1 million per year. So that is significant. So capital markets should coordinate with finance, should coordinate with servicing, trying to understand what is, by releasing or retaining, let's say 30%, will that cover the shortfall and the service fee income? Those are the questions should be addressed in coordination with all the divisions together in order to facilitate and make sure the overall revenue basically stays level or increase, in this particular case. So cooperation and combined effort among all players within the company is crucial to sustain future income for the company.
Thank you. Decision-making and analysis, this is just to piggyback a little bit off of Azad, just making sure accounting and secondary, I love his comment on getting kind of the whole team together in the decision-making. Just a couple of questions to think about as you kind of go through your servicing analysis. What is the servicing truly worth to your company? Is it the MSR sale price? Is it the cash flow that you're getting in the future from your servicing fee revenue net of all of your expenses, do you have a really good understanding of your subservicing fees and expenses? How does that compare to what your valuation company is putting in your MSR valuation? If they're using a market cost to service and your cost to service is a lot higher or lower, that valuation isn't maybe going to be in alignment as well with what your future cash flow should be, which is tricky because GAAP requires you to book your MSRs at market value, not the value that you actually earn from that servicing portfolio within your company. So MSR portfolio financial management essentials, Azad, what would you identify?
Yeah, thank you, Jennifer. I'll sum up this slide in two areas. One is moderate fair value levels. You need to capitalize loans at moderate fair value levels to ensure you mitigate any risk. And also keep an eye on escrows, because escrows are the second variable that adds value to the portfolio. It's about 30 to 40% of the overall value. So any changes to the float income rate could significantly impact the overall value of the portfolio.
Okay, so I just want to make sure that we get through this last poll question for everybody on the presentation to make sure those of you that have to drop off at 1 get your CPE credit. So this you'll get, when we send out the recording, we'll send out the slide deck too. So feel free to read through that. If anyone has questions, reach out to us. How frequently do you review servicing cash flows and compare those servicing cash flows to the third-party valuation to subservicing invoices? So you've got your cash flow provided by your valuation company, and you also have your invoices showing you all of the revenue obtained from your subservicers that you're potentially using, or you're paying attention to that if you're in-house. How often do you look at that? And this will be our last poll question. I just wanted to say a giant thank you to Azad and Bill for all of this great information and being a part of our webinar today. And as Gabrielle mentioned in the beginning, we'll send out the recording and the slide deck to everyone. And sorry for the time constraints, but I'll reach out individually for any potential questions that we had that we weren't able to answer. So if you have to hop off, I just wanted to make sure you got your CPE, and we'll continue on with the last couple of slides. Okay, I'm going to go to the next slide. So once per quarter, once per year as needed. That's a good amount of people kind of doing that analysis. That's good to hear. Okay, MCT. Azad, Bill, if you want to take this one.
Azad?
Yes. The retention strategy should focus, as I mentioned earlier, should focus on the entire business, not just income generated through the release. Even though it's very, very tempting to release everything, but if you carry a servicing portfolio, you should look at the servicing portfolio and figure out a way how to maintain your fee income, interest income, other income level, if not increasing it over a period of time. Even though portfolios are very important, it could generate revenues, even though it's deferred, but it's essential to the entire operation of the entity itself. And primarily focus on that scheduled principal payment, because it is there And a lot of companies only focus on the CPR, the prepayment, and overlook the importance of the principal payoff, a principal pay down.
That was very helpful. All right, we are right on time at 1 o'clock. Again, just a giant thank you to John, Azad, Bill for the presentation and your time. This was fun. Okay.
I think are we at the end? That was great. So yeah, we again, Jennifer and John, thank you to you and the entire Richey May team. We appreciate the partnership and the opportunity to collaborate with you on this. We enjoyed it. Hopefully, the folks that dialed in picked up a few things, and please let us know if there's anything that we can do to help. And I'm sure Jennifer, you and your team stand ready as well.
Absolutely. Thanks, everybody. Thanks for attending.
Okay.
All right.
Thank you.
Thank you.
Thank
Bye-bye.
you.
Thank you.